Overnight, the US dollar falls 40%. No war, no invasion, no cyber attack, just markets. This is a chronicle of the next 180 days, a journey from the first spark of panic to the total destruction of life as you know it. What broke? It didn't start in America. It started in Asia. At 2:17 a.m. Eastern Time, China's central bank announced an emergency liquidation of U.S. Treasury holdings. Not gradual, immediate. At the same time, Saudi Arabia confirmed oil contracts would be settled in a multi-currency basket. The petrodollar assumption cracked in a single news cycle. Within hours, sovereign wealth funds followed. Bond yields spiked, currency markets froze. And when the largest buyers of U.S. debt signal they no longer trust the long-term value of the dollar, confidence evaporates. This wasn't a war. It was a coordinated exit. And markets understood the message. Day 1. Shock turns to panic. Trading halts didn't calm anyone. They amplified fear. When markets reopened, the dollar fell again. Minus 12%. Minus 23%, minus 31%. By evening, minus 40%. ATMs ran dry in major cities. Banks limited withdrawals. Not because they were insolvent, because they were overwhelmed. Gas stations formed lines within hours. People weren't buying fuel. They were buying control. Supermarkets saw panic purchases. Canned goods, rice, baby formula. It wasn't chaos everywhere, but in enough places to dominate social media. And perception spreads faster than policy. Mark tried to withdraw $2,000. His bank limited him to $500. For the first time in his life, money felt restricted. Day 3, fear becomes personal. Prices didn't rise. They jumped. Imported medication shortages began appearing in pharmacies. Fuel, up 35%. Electronics, up 60%. Groceries, unstable. Some unchanged, some doubled. Mark's daughter needs a minor surgery in 2 months. Insurance company sends a notice. Coverage adjustments under review due to cost volatility. Translation? Premiums increasing, possibly immediately. At work, the logistics company loses 3 international contracts. Clients demand payments in euros. The company cannot hedge fast enough. Layoffs begin. Not rumors, actual names. Mark survives the first round. But his manager says, if revenue doesn't stabilize, we cut again. That night, Mark and his wife argue. Not about money, about security. Should they move savings into foreign currency? Buy gold? Pay down the mortgage? They don't know what is safe anymore. And that uncertainty is heavier than the price increases. Day 7. Systemic stress. 1 week in. The headlines aren't louder. They're colder. The Federal Reserve announces emergency stabilization, liquidity facilities, bond purchases, rate adjustments. The dollar stops falling, but it doesn't recover. And that's worse, because now people realize this isn't a glitch, it's a reset. Oil exporters begin demanding partial payment in euros or yuan. Shipping insurers raise premiums. Airlines hedge fuel aggressively. Importers renegotiate contracts. Global trade doesn't stop, but it slows. And when trade slows, supply chains tighten. Supermarkets begin limiting certain products. Electronics spike another 30%. Construction projects pause mid-build. Why? Because materials are globally priced, and America just lost purchasing power. Housing freezes, no buyers. Sellers lower prices, then lower them again. Luxury stores sit empty. Discount stores overflow. Uneven instability spreads, and uneven feels random. Mark checks his retirement account. Down 28%. He doesn't panic sell. He just closes the app. For the first time in his adult life, he doesn't trust the long term. Month 1. The second wave. 30 days later, the shock becomes structural. Prices are no longer the headline. Employment is. Small import businesses close quietly. Retail chains announce strategic restructuring. That word means layoffs. Job market flooded. Hundreds applying for the same role. Wages haven't caught up, but prices have. Imported food feels premium. Electronics feel luxury-level expensive. International travel disappears for most households. Mark's daughter's surgery is postponed. Not canceled, postponed until pricing stabilizes. That sentence lands heavier than the layoff. Because now it's not about income, it's about access. Mark always believed that if he worked hard and saved consistently, he was insulated. Now he understands insulation depends on currency, and currency depends on belief, and belief is fragile. Month 3. Adaptation or decline. 90 days in. The panic is gone. The adjustment remains. Exporters benefit from the weaker dollar. Domestic manufacturing ticks upward. Slowly. Factories don't appear overnight. Inflation stabilizes at a higher plateau. Interest rates remain volatile. Trade contracts begin referencing currency baskets, not to destroy the dollar, to hedge against it. Central banks quietly diversify reserves, not dramatically, but measurably. And slow structural shifts are the hardest to reverse. Mark picks up contract work, lower pay, no benefits, no guarantees. His wife starts selling unused items online. They cancel a vacation, refinance at a higher rate, cut discretionary spending. They aren't collapsing, they're recalibrating. But something changed. They trust the system less. And once trust cracks, behavior shifts. Quietly, permanently. Day 180. A different normal. 6 months later. There are no flashing crisis banners, no riots, no apocalypse, just thinner stability. Inflation holds at 9%. Interest rates higher than pre-crash norms. Government debt servicing consumes a larger share of the federal budget. Political debates intensify. But daily life continues, just tighter. Mark plants a vegetable garden in his backyard, not as survival, as a hedge. He converts part of his savings into foreign exposure. He doesn't trust concentration anymore. His daughter finally has surgery. It costs more than expected. Insurance covers less. They use savings they once thought untouchable. The dollar didn't collapse into irrelevance. It lost its aura. And aura is power. This was a simulation. It hasn't happened, but it could. The dollar is still dominant, for now. Other currencies aren't trying to destroy it. They're building alternatives, waiting for the right moment. Because no currency leads forever. History doesn't work that way. So the question isn't, will it crash? It's simpler. If the shift began, would you see it, or only react to it?